Philip Arthur Fisher was an American stock investor. Best known as the author of Common Stocks and Uncommon Profits, a guide to investing that has remained in print since it was first published in 1958. Fisher's career began in 1928 when he dropped out of the newly created Stanford Graduate School of Business. Later he would return to be one of only 3 people ever to teach the investment course. He started working as a securities analyst with the Anglo-London Bank in San Francisco. He switched to a stock exchange firm for a short time before starting his own money management company, Fisher & Company, founded in 1931. He managed the company's affairs until his retirement in 1999 at the age of 91, and is reported to have made his clients extraordinary investment gains. Although he began some 50 years before the name Silicon Valley became known, he specialized in innovative companies driven by research and development. He practiced long-term investing, and strove to buy great companies at reasonable prices. He was a very private person, giving few interviews, and was very selective about the clients he took on. His most famous investment was his purchase of Motorola, a company he bought in 1955 when it was a radio manufacturer, and held it until his death. Fisher is remembered for using and proliferating the Scuttlebutt, or grapevine, tool, in which he searched fastidiously for information about a company. When you scuttlebutt, you make more informed decisions due to a better basis for analysis and valuation. In his book, Paths to Wealth Through Common Stocks, Philip Fisher introduced the Scuttlebutt method for researching potential investments. This method was notably applied in his analysis of Corning Glass Works, one of his most recognized investments. The Scuttlebutt method involves a 15-point checklist that investors should consider. 1. The company should have products or services with enough market potential to significantly increase sales for several years. 2. The management should be determined to develop products or processes that will further increase total sales potentials once the growth potentials of currently attractive product lines have been largely exploited. 3. The company's research and development efforts should be effective in relation to its size. 4. The company should have an above-average sales organization. 5. The company should have a worthwhile profit margin. 6. The company should be taking steps to maintain or improve profit margins. 7. The company should have outstanding labor and personnel relations. 8. The company should have outstanding executive relations. 9. The company should have depth to its management. 10. The company's cost analysis and accounting control should be good. 11. There should be other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition. 12. The company should have a short-range or long-range outlook in regard to profits. 13. In the foreseeable future, the growth of the company should not require sufficient equity financing so that the larger number of shares then outstanding will largely cancel the existing stockholders' benefit from this anticipated growth. 14. The management should talk freely to investors about its affairs when things are going well and not clam up when troubles and disappointments occur. 15. The company should have a management of unquestionable integrity. This checklist provides a comprehensive framework for investors to evaluate potential investments. It emphasizes the importance of thorough research and understanding of a company's operations, management, and industry position. In the 2018 Berkshire Hathaway Annual Shareholders Meeting, Warren Buffett called Fisher's Common Stocks and Uncommon Profits a very, very good book. He further described how using Fisher's Scuttlebutt technique continues to be a good way to investing, which is still used by Ted Weschler and Todd Combs at Berkshire Hathaway. John Train described Warren Buffett as 85% influenced by Benjamin Graham and 15% by Philip Fisher. Philip Fisher shared a wealth of investing wisdom in his writings. Here are some additional insights. 1. Quality over quantity. Fisher believed in investing in a few excellent companies and holding onto them for an extended period. His strategy can be summarized as buy and hold, with a strong emphasis on due diligence, qualitative insights, and a concentrated portfolio. 2. Holistic understanding. Fisher emphasized the importance of a holistic understanding of a company's business model, its competition, and the industry it operates in. He believed this is crucial for predicting its long-term success. 3. Scuttlebutt method. Fisher's Scuttlebutt method emphasizes gathering holistic insights about a company, which aids in validating facts, uncovering unique opportunities, and mitigating potential risks. 4. Influence on other investors. Notable figures, including Warren Buffett, Acknowledge Fisher's influence on their investment approach. 5. Investment in high-quality companies. Fisher's investment strategy prioritized qualitative insights. He emphasized a buy-and-hold strategy of high-quality companies after thorough due diligence. 6. Understanding businesses in depth. Fisher's books emphasize the importance of understanding businesses in depth, recognizing broader industry trends, and prioritizing quality in investments. 7. Innovation and groundbreaking investment strategies. Fisher brought his innovative and groundbreaking investment strategies to Fisher & Company, providing his clients with remarkable returns. The firm's approach focused on uncovering high-quality companies with robust management through rigorous research and analysis. 8. Investment in out-of-favor stocks. Fisher believed in identifying companies whose market prices are significantly lower than their intrinsic values. If multiple companies meet this criterion, he would choose the most undervalued one to minimize risks. These insights offer perspectives on long-term investing, understanding a company's management, and the multiple elements that form Fisher's philosophy of growth investing. Philip Arthur Fisher is the father of Kenneth Fisher. He is the founder of Fisher Investments.